Hi, this is Demo Gonzalez of Heartwood Financial Services. Welcome to another market update video. We finished up April with another pretty good month. It's been a pretty good year to date, and I'm excited to tell you a little bit about how things are going. Also to tell you about some of the things that folks are talking about, some important topics that I think are important to consider. And also, as always, what's coming down the pike. I've also wanted to mention that I've been getting a lot of good comments about the videos. Thank you for the feedback, the positive and the negative. It's all helpful as this is pretty new for me. But enjoy the video, and we'll talk soon. Well, first let's start with a quick recap of the asset class returns. As you can see from this chart here, on the top, the small cap stocks have performed the best, up about 18.5%. Large cap right behind at 18.2. At this point, the large cap stocks have basically recaptured what they've lost from back in the fourth quarter. So we're already at some new highs, just barely, but we're at some new highs with large caps. REITs have continued to do pretty well. Developed market equity, 13.3. Emerging market equity, 12.3. They've been doing pretty well, not quite as well as the domestic large caps and small caps. A lot of that has to do with the currencies. The dollar's been very strong. And when you invest in these emerging and developed market international stocks, you do buy in the local currencies. So that does translate to a lower return with a strong dollar. Now the asset allocation portfolio, again, that's like a 60-40 type mix. Also in double digits, about 11.3. High yield bonds at 7.2, commodities 5.9, fixed income at 3, and cash at 0.8. So overall, another pretty good month, and things are looking pretty strong so far year to date. So here's a quick recap of where we are with the market right now on the valuations. This is as of today. Now the market is up today, so I got a little bit of that in the numbers here. But if you've seen the chart before, we're expecting essentially a 3.1% growth in earnings. And I'm going to talk a little bit more about that later because there are some revisions that are going to be happening soon, I think. But based on where the stock market is right now at 29.43 and historical 25-year price to earnings ratio, the stock market should be at 27.14. So if you, again, add in the dividends, we are a little overvalued right now. So what we're looking at is about a 7%, almost 8% overvaluation in the market. Now, will that mean that the market's going to go down? Well, we know how the market can be. Sometimes it can go a little high for a little long, and sometimes in the reverse be a little too low for longer than it should. Will remain to be seen, but there are some things that are happening that might change the metrics of these numbers that I'm going to talk about here next. So here are the leading indicators, and maybe a reason why the valuations are a little higher right now. The leading indicators, as you can see from this chart, have been moving up very nicely. What's interesting is the gray bars here show where there are recessions. And you can see right before you get into recession, you get a little deceleration of the leading indicators. You can see that on each one of these areas here. Very interesting. And when you go to where we are today, we're kind of in the slope where it's starting to slow down. So the question would be, are we slowing down, getting close to a recession, or are we just in a little temporary slowdown? And that's the million-dollar question. I think we're probably more in a temporary slowdown, but that remains to be seen. So this is something we'll have to keep a close eye on. Now, even more important, the earnings numbers have been holding up pretty nicely. This graphic here shows you how in the first quarter, earnings were supposed to be pretty bad. And here, as you can see, the beats on the first quarter have actually been about as good as they have been on other quarters. Now, the numbers did get lowered quite a bit, so it was easier to beat. But still, the surprise has been that earnings have been coming in pretty good. I'm not saying great, but they've been coming in pretty good, certainly a lot better than expected. And on the other side, you can see the revenue figures as well. The beats here have also been okay, not great, but they didn't fall off a cliff. So maybe this is one of the reasons the market is slightly overvalued, because earnings essentially are undervalued and doing better than a lot of people thought. So another reason the market is where it is now, which is again a little on the high side, is because the Fed has been on pause. They have been very patient, and as you can see here from this chart, the inflation figures have been pretty low. Right here you can see that the historical average is around 4% and we're a little under 2%. 2% is their target. So they're staying just under 2%. And until we start to get above that, I don't think we're going to hear much from the Fed about raising rates. Now, every time the economy has good numbers and employment numbers go down, there are talks that maybe they might raise rates again. But it does come down to this inflation figure. So thankfully, this has been a pretty low number. And if it continues, I think we'll have a very dovish Fed, which again will be good for the markets and keep the valuations a little elevated. Now, another factor to look at is employment. And employment has been very strong. As you can see from this chart here, employment numbers, or unemployment I should say, has been going down dramatically here over the last several years. In fact, we just got the headline numbers today, and the unemployment number is actually down to 3.6 now instead of 3.8. So this might bring the Fed back into play. But wages, which is the blue line here, has actually been going up nicely. But the wage number that we got for this month was 3.2. So it's not showing that it's increasing. It's kind of flattening out. So that might help keep the Fed at bay for a little bit longer, but we'll have to see. Right now, it seems like we're in a pretty nice little sweet spot because the Fed is not doing much because they're not seeing strong wage inflation. So in conclusion, the market's been coming back very nicely year to date, but the valuations are a little bit expensive. As you've seen, there are some reasons why. Earnings have been getting better, inflation has been low, so the Fed has been at bay. But unemployment is very low and the wages have still been pretty good. So if that continues, the Fed might come back into the picture and talk about interest rates going up again. And here we go all over again, what happened in December. So that's why I've been starting to play a little bit safe and tapering a few of the gains. But I still remain in a neutral stance, which means that we're pretty much fully invested compared to the benchmarks. But I'll keep an eye on things and continue to monitor things to see if we need to make any changes going forward. Thank you so much for your time today and for your trust in my guidance of your portfolios, and appreciate you tuning in. This last slide here is to honor my friend Brian, who just found out over the weekend that passed away. He was a friend of mine that I worked with at Fidelity for many years. He was a lot of fun to work with. He passed away way too young, only 52 years old. And it prompted me to become a little introspective here in the last few days. And so I want to leave you with this last quote. So often we become so focused on the finish line that we fail to enjoy the journey. And so the message here is, we always want to get to the end. We want to achieve our goals. And sometimes we miss a little bit of the fun, a little bit of the laughter along the way. And just want to remind everybody that the journey is a lot longer and will last a lot longer than the finish line. And so let's try to enjoy that journey a little bit more. And as you know, a lot of times when I speak to you, I'm really speaking to myself. But I hope you find this message inspiring, and I hope you found the video helpful and interesting. And tune in again next month. Thanks.